Hello, everybody. We are back. Let's take a look at that homework I had you do. I believe I had you do the Goodman handout. Is that correct? Go ahead and show that if you would. I think I showed the answers in class and/or for you online folks. This might have been in the back in your selected answers. But take a look at those first four. I'll move up the sheet here in a minute. Any questions about 1 through 4 on Goodman? Anybody? Let's take a look at the amortization table. Okay. Now, this amortization table won't go to a 0 unamortized premium because it's only the first 2 years of an 8-year bond. Is that right? Okay. So take a look at that. If you're off by $1 or whatever, $1 or $2, I'm not too concerned about it. Okay. I think I asked you on this one to round to the nearest dollar. Okay. Now remember, on the test, I am going to give you the amortization table, but I'm not going to tell you how to compute what goes in there. Okay. So these formulas won't be there. Okay. All right. Any questions on the first page of Goodman? No? All right. Well, let's go to the second page. Now the second page is preparing interest payments largely based off what you did on the amortization table, right? I think it's easier to do that amortization table and then to do your journal entries from those. And of course, every journal entry has to balance, right? The debits have to equal the credits. What type of account is premium on bond payable? Remind me? It's an adjunct liability. Very good. An adjunct liability with a normal credit balance. Okay? Cool. And you can see, I'll move it down now, you can see how it would look on the balance sheet at December 31st, 2014. Make sure you always pay real close attention to what that date is on the test that I'm asking you. Don't just assume it's the last line or something like that. But with a premium on bond payable, since it's an adjunct liability, we add it to the par value to get the carrying value, correct? And then, of course, this is the journal entry to extinguisher when that thing matures. All right? Questions on that? Okay, let's go ahead and take a look then at the Shraer handout. Is that correct? Hopefully these are getting easier as you have more practice. Okay, there is the first 4 of the Shraer handout. Okay, I won't read through that. You can read it right there. I think I did ask you to round to the nearest penny on this one because it's a 2-year bond. And I wanted to be able to show on the amortization table that sure enough that unamortized premium does go down to 0 and that the carrying value does go down to par. Okay? So there are the first 2 or the first 4 answers. Okay, I said here that the bonds are sold at 103.855, right? So you guys remember what that meant, right? They are sold at 103.855. That means we take 1.03855 times the par value of 40,000 to get the cash proceeds, right? Okay. All right, let's take a look at the amortization table. Now, again, I had you go to the penny. If you're off by $1 or $2, it's no big deal, okay? The last row, again, since this is only a 2-year bond, this is the last period of the bond. This row right here, correct? So this needs to be 0. So again, the way that I think through this is if I know I only have 1 period left after this one's shown, I know I have to amortize that full amount of premium, okay? This is 1,000, and then this is just the difference between these two. That has to go to 0. This has to go to par value. Okay, so did you guys get that? Luke.
So you want us to force it all the way back to the bond interest expense rather than just
Well, you've got to force that whole row. And the reason you have to force that whole row is, take a look at it. You know you have to force this number, right? And you know that number is going to be 1,000, right? So you have to force this number too, or your journal entry that you prepare on June 30th of 15 is not going to balance. You see what I'm saying?
Right.
So yeah, you have to kind of force all of these columns. Okay? Good question.
And if we didn't, it'd be wrong.
If you didn't, it'd be wrong. And you might flunk the whole test and have to take the whole class again. So it's pretty important. No, I'm just kidding.
Because I got the numbers that you crossed out, and then I just, on the unamortized premium, I just put 0.
Yeah,
That
but
was the only
see,
thing I changed.
but if you do that, oh, you just put 0 here and then use these two numbers?
Yeah.
You know, I mean, I really probably wouldn't on a test have. Well, but look at that. Look at that. Then you still, if you use 39408, if you reduced your balance of 394.35 of unamortized premium by only 39408, you still have a balance in your unamortized premium.
Yeah.
You see what I'm saying? So this has to be 0, and your unamortized premium needs to be 0 when this is all said. So you really got to force this, you got to force this, which means you got to force this. And of course this will be par. So you really do need to force all 4 of those. Okay, cool? Okay, good question though. Remember the journal entries. And you need all your journal entries to balance. Your total debits need to equal your total credits, correct? So take a look at those for Shraer. Remember, you folks at home, you folks here too, you can always print these out again and see if you can do them. That's the best way to study for a test, isn't it? Okay, best way to study for a test. All right. Okay, let's move this up. Okay, let me zoom out a little bit, because what I think I had said was, I wanted to see how it would look on the December 31, 2014 balance sheet, which was this journal entry, which had to do with which line on the amortization schedule. This one right here, right? Okay, so our carrying value is 40394.35. Our premium is 394.35, and of course our par is 40,000. Okay. Always make sure, what date am I asking on, so you go to the right line of the amortization schedule. Okay? All right, questions on that? Anybody? Okay. All right. Okay, going over the computer real quick, I wanted you to read on page 568 about the definitions of these bonds. Is that correct? This wasn't real difficult. And then I wanted you to do quick study 14.8. Is that correct? Okay, so let's do that one real quick. I had to cover up the answers because I wrote in my book. Okay? All right. Quick study 14.8. All they're asking is for us to enter the letter of the description A through H that best fits each term or phrase 1 through 8. So it's just matching. Okay, you can come off that now. Let's go ahead and do this. Okay, a registered bond. Which definition is that? Registered bond, number 1 is what? A. It records and tracks the bondholders' names. It's registered in their name. Okay? Cool. Number 2, a serial bond. A serial is what? Number 2 is C. It has varying maturity dates. for amounts owed, okay? Varying maturity dates for amounts owed. So number 2 is C. Number 3 is a secured bond. What does that mean? H. There's a specific asset pledged as collateral, isn't there? Okay? If you have an auto loan, that's an example of a secured loan. Because if you don't pay your auto loan, what are they going to come do?
Take the car.
They're going to take your car. Okay? So number 3 is H. Number 4, bearer bond. Which definition is that? F. It's unregistered. Payment goes to whoever possesses them. Okay? Interest payment goes to whoever possesses them. So 4 is F. Number 5, convertible bond is what? E. It can be converted or exchanged, perhaps, for the issuer's stock. Certainly not all bonds are like that, but convertible bonds are. Number 6, bond indenture. What is number 6? D. It identifies the rights and responsibilities of the issuer and the bondholders. It's kind of like maybe like you would think of the contract. If you had to sign a bunch of loan papers, that's kind of like the bond indenture. You know, who is supposed to do what, has the rates and all that sort of thing, dates. Number 7, sinking bond fund. What is that? G, maintains a separate asset account from which bondholders are paid at maturity. Okay? What that's kind of like is, let's say you had an auto loan that was payable over the next 4 years. Well, what if you set up a separate checking account, you put money in there, and you didn't use that money for anything except to pay off that auto loan? Maybe you even had an automatic payment out of that account. So you could almost forget about the liability and the asset, couldn't you? That's like a sinking bond fund. Blake.
It's sinking fund bond.
Thank you. Sinking bond fund, sinking fund bond. Yeah, thank you. Okay, so number 7 is G. Number 8 is debenture. What is a debenture?
B.
It's B. It's unsecured, okay? It's backed only by the issuer's good standing, okay? So the answers for those are right there if you missed one, okay? Any questions on that? That's pretty easy, isn't it? Okay, one last thing I want to touch on in regards to bonds before we move on from this chapter. Let me go back to the computer. Do you remember when, let me go back to an example. Remember when I would tell you the issue price was like 103.546% of par, or for bonds sold at a discount, I gave you the issue price and it was less than 100%, right? And remember how I said don't worry about how I come up with that number? Do you remember that? Okay, well I want to at least tell you how we come up with that number because I know it's been bothering you, okay? What we do is, how are bonds priced? Well, before we give the answer here, and come off that. Think back to when we did time value of money. Do you remember that one bond that, or it wasn't a bond, that one investment that paid $10,000 at the end of the term, but it also paid $400 per period during the life of it? Remember that? And do you remember how we figured out the present value of that $10,000, and then we figured out the present value of that annuity of $400, and then we added those two answers together? Do you remember that? Okay. Well, that is the same methodology that we use on how a bond is priced, looking at this. What we do, the price of a bond is determined, we take the present value of the expected future cash flows for the bond. This involves discounting or finding the present value of the future interest payments, and also discounting or finding the present value of the future payment of principal, the par value at the maturity, okay? Using the market rate of interest. Are you with me? So that is how you figure out the price of those bonds, okay? Now, we used to spend some time actually doing this, but I don't really do it anymore. Again, we have a finite amount of time. in 25 years of accounting consulting, I've never once figured out the price of a bond, okay? But it would be more just a time value of money, question than anything, all right? But that's kind of the methodology about how we came up with that, all right? We just discounted or found the present value of those future cash flows. So I at least wanted to make you aware of that, all right? Any questions? Okay, we're getting ready to start chapter 16 now. Now, chapter 16 is the final chapter we have before we have another test. So we will have, at least 3 lectures and maybe 4 lectures on chapter 16. Okay, so in other words, we have 3 or 4 more lectures and then the next test, which would be over time value money, chapter 14, chapter 16. Does that make sense? Yep. Just to kind of give you an idea of where we are. All right? Okay. This chapter 16 is over the statement of cash flows. Okay? It's over the statement of cash flows. And you can come off of that. Do you remember in Accounting 1 when your instructor introduced the basic financial statements? And what was does anybody remember the first financial statement that you prepare?
Income statement.
The income statement. And then what's next?
Statement of owner's equity.
Statement of owner's equity, and then the balance sheet, right? And you prepared those in Accounting 1. And I can remember mentioning, and then there's a 4th financial statement that's prepared along with these 3, but we don't prepare it in Accounting 1. It's beyond the scope of the class. And I said, it's the statement of cash flows. You'll learn how to prepare that at a future date. Remember that when I said that? This is that future date, okay? I'm going to teach you how to do the statement of cash flows. We don't teach it in Accounting 1 typically because it's just a little too much for brand new Accounting 1 students to grasp. They need to get some of their accounting basics underneath or under control before they can learn the cash flow statement, all right? So we're going to teach you how to do the cash flow statement. I love to teach the cash flow statement. It's one of my favorite chapters to teach. Now, let me ask you this before we go to it. Does anybody keep track of on a personal basis, or if you have a business, does anybody keep track of their cash flows like you do, Luke? Like, what do you keep track of?
I guess mainly just all the expenditures like grocery and gas.
Groceries and gasoline. Okay. Does anybody else do that? Okay. You do that, Matt?
Just track everything that comes in, everything that goes out.
How do you track it? Do you use
Excel spreadsheet.
You use an Excel spreadsheet? Okay. Luke, what do you use?
I use envelopes just to have like a total in that account, I guess.
Oh, you use the cash envelopes?
Yeah.
That's a good system. When there's no more cash in the envelope?
There's no more to spend, yeah.
Yeah. My wife and I have done that before. So, why do you keep track of these things? Matt, Luke, anybody else who does? Why?
You know where your money's going.
You want to know where your money is being spent, right? What other reasons? What other reasons do you do it? Why do you use the envelope system?
I guess just ease of mind knowing that I'm properly allocating my resources.
Okay. And knowing not to overspend on certain categories, right? And it probably gives you a little peace of mind because if you have an expenditure but you know that there's the ample cash in the envelope, right? That you have that, okay? Do you have any debts that you have to pay? Either one of you? Auto loans or student loans yet? No? Okay. Sometimes you want to know if you're going to have enough money to pay tuition or pay your auto loan payment. Sometimes you need to know if you're going to have to take out an additional loan. But you like to keep track of, too, of how you're making your money, right? Now, I'm not sure if you guys are working a job right now, but you want to know kind of how much you're making as compared to last month or whatever, right? Okay, well, let's take a look at the slides now. The same reasons that an individual would keep track of their cash flows pertains to why a business would keep track of their cash flows. They want to know, how does a company obtain its cash? Where does a company spend its cash? Where are we spending our money? Is our cash balance going up or is our cash balance going down? Okay? Furthermore, how did we fund our operations? Do we have sufficient cash to pay our liabilities? Maybe, think about the bonds. When it comes close to pay that principal off, you better have enough money, to do that, right? Enough cash, correct? Okay. Can we afford to make some dividend payments? Can we afford to pay back some loans, or do we even need to get another loan, right? These are all the questions that a business would ask, or at least some of the questions that a business would ask. Is that correct? Okay. Now, let's come off that for a second. Let me ask you this. What system of accounting did we use when we prepared the income statement and the balance sheet and statement of owner's equity? What system of accounting did we use?
Double entry.
Well, we used double entry, but it starts with an A. We used not the cash method, but the first two letters are A and C. The next letter is a C. Then there's an R.
Accrual.
The accrual method. Yes, we use the accrual method of accounting. Remember the accrual method of accounting? Is that ringing bells now? Remember, that's why we prepared journal entries, right? Because we want to follow the revenue recognition principle that states we recognize revenue when it is earned. When is revenue earned? Does anybody remember? When you've provided the product or the service. Not necessarily when you receive cash, remember? Remember, we recognize expenses when they are incurred. This is the matching principle. Is this ringing some bells? Okay. What you will find out is, and I told you this in Accounting 1, is we use the accrual basis of accounting. And the reason is because if you use the cash basis of accounting, now the cash basis of accounting says, hey, whenever you get the money is when you record the revenue. Whenever you pay out the money is when you record the expense. You see what I'm saying? But that is very easy to manipulate. Because I could boost up my bottom line by telling my people, hey, at the end of December, do not pay any bills. Pay them all in January, because I don't want my expenses to be recognized until January, right? Or you could even tell your customers, hey, will you do me a favor? Pay me in advance for products or services that I'll provide next year. But get me the cash in December so I can record it as revenue. Now, you see how easy that would be to manipulate a bottom line with the cash flow basis? Okay. So that is why on the balance sheet, the statement of equity, and the income statement, that is why we use the accrual basis of accounting. Okay? However, how does the cash flow statement come into play here? Well, let me ask you this. Have you ever read a story about an athlete or movie star, or maybe you even know somebody, and they are declaring bankruptcy, and they've made a ton of money, and now they're declaring bankruptcy, and you're like, wait, that person made millions and millions of dollars every year. They lived in a huge house. They drove the nicest cars. They had wonderful vacations. How in the world did they declare bankruptcy? Can anybody think of any examples of real life people? Any athletes? Anybody?
MC Hammer.
MC Hammer is the one from my generation. Do you know who MC Hammer is? He was extremely popular in like 1990. And he just made millions and millions of dollars, and then he went totally bankrupt. What about athletes? There's a great 30 for 30 documentary on ESPN called, I think it's called Broke, about athletes who go broke. And the percentages of athletes who, 5 years after they're done with their profession, they are completely broke. There's countless of them. I mean, there's just tons of them. There's tons of them. Overspending. Yeah. Well, the problem is this. And I know this from doing back in my early days of accounting when I used to do some tax work. There are people who, when you drive by their house, they have wonderful house. They have wonderful cars. They got Sea-Doos in the parking lot. They got kids wearing Baby Gap clothes. They got a lake house down in Branson. So in other words, they have a lot of assets, right? Now you can't see the liabilities. They have a lot of liabilities too. And if you knew what Dad did for a living, and if you knew what Mom did for a living, they make really good money. And so their revenues on their personal income statement look really nice. Now, they probably have healthy expenditures too. But here's the problem. A lot of time those people have no cash. No cash. And if you ask them to get $500 together by the end of the day, they may not be able to do it. And you would think, are you kidding me? This is a $500,000 home. Mom and dad both make, $250,000 a year, and they can't. That's true. It happens all the time. Many a business that had a healthy balance sheet and a healthy income statement went out of business. And why did they go out of business? They have no cash. They ran out of cash. Couldn't pay for their inventory. Couldn't pay their employees. They couldn't pay for operations. And you go, their balance sheet looks great. Their income statement looks fine. Well, their cash looks bad. So the cash flow statement comes into play here. In a way, it's like this. Think of somebody who is looking at these, an external reader saying, okay, I see your balance sheet and I see your income statement. That's great. You use the accrual basis of accounting. I'm not sure I completely understand that. Okay, I also want to see, let's cut to the chase. I want to see what was your cash at the beginning of the year? What was the cash at the end of the year? Where did you get your cash? Where did your cash go out to? What expenditures did you have? You see what I'm saying? Do you guys remember high school government? And you learned in the United States the 3 branches of the government. Does anybody remember the 3 branches of the government from high school?
Legislative,
legislation,
judicial, and executive.
Yes. You have the executive branch. You have the executive branch. You have the judicial branch. You have the legislative branch, right? Well, one of the reasons that the founders of the country concocted that method was to kind of be checks and balances on the other, correct? Okay. Well, I want you to kind of think of that analogy in regards to the 3 financial statements. There's actually 4, but the 3 I'm going to focus on are the balance sheet, the income statement, the cash flow statement. Okay. So you have the balance sheet, right? You have the income statement, and now we're going to learn about the statement of cash flows, right? These should sort of be checks and balances on each other, kind of like those 3 judicial branches. And what you'll find is this. When companies are trying to get loans, or companies are trying to attract investors, or trying to sell stock, or trying to have a nice annual meeting with the shareholders, a lot of times what they'll say is this. They'll say, hey, man, look at our balance sheet. Isn't that awesome? We have an awesome balance sheet. That is sweet looking. Look at our income statement. Wow. Look at these 2 things. Look over here. Look over here. Isn't that great? And now the astute investor would say, well, what's under there? Well, that's a statement of cash flows. Don't worry about that. But look at these, man. These are really nice, right? Or another thing they'll try to do sometimes is these 2. They'll say, hey, look at our income statement and our statement of cash flows. Man, those are sweet looking, aren't they? But what they won't let you see is the amount of debt that they have. Okay? Now, usually everybody always wants to see the income statement. They want to see the income statement. But a lot of times they will try to hide the cash flow statement or the balance sheet. Okay? One thing that we found out during the financial crisis of a few years ago, here's basically what was happening in a nutshell. Banks were extending credit, giving loans to businesses who were in big trouble. They should never have been giving these people loans. They were having trouble paying their existing loans. Okay? And what we found out during that time is a lot of bankers, well, first of all, these commercial loan officers, they want to loan money, right? They want to loan money. So here's what they were doing, a lot of these. They were looking at the income statement. And if the bottom line was positive, let's give them more credit. Sometimes they would take a look at the balance sheet, okay? And to be fair, sometimes they would look at all 3 of these, but, you can come off that. But anybody who understands financial statements should have known that something was up. I went in and did consulting for a company. I won't tell you who it was, but the bank called us in because they couldn't make their loan payments anymore. And we looked through their financial statements, and we could just tell by doing analysis of these 3 statements that something was wrong. Something was wrong, because there's no way this could be true and this be true and this be true. Okay? Make sense? Okay. Let's say, Henry, that I looked at your test grades in this class, and let's say you averaged an 87% on all your tests. And then let's say I looked at your quiz grades, and you averaged 95% on all your quizzes. Okay? And then I looked at your total grade for the class, and you had an F. Well, something's wrong here, right? Because this class is pretty much all quizzes and tests, is it not? And an astute person would say, this doesn't pan out, right? This doesn't seem to, something's wrong here. Something's wrong here. But a lot of the banking people were not astute enough or didn't take the time enough to take a look at this. What we found out is, and this company went out of business, but this bank had actually given this company another $2 million of cash just 8 months before they called us in when things were in trouble. So the bank lost millions of dollars, had to write off the loan. Okay? So it is important that you understand, you guys are getting to the level of accounting now where you start to actually use some of this debit and credit stuff. You need to be able to analyze those financial statements. Does that make sense?
They just wrote off a $2 million loan.
Well, do you know what that means by writing it off? When you say you write it off?
I guess not.
It's funny because there's an episode of Seinfeld. Does anybody remember that episode of Seinfeld where Kramer talks about how you just write it off? And Seinfeld says, you don't even know what that means, do you? And he says, no, nobody knows what it means, but you just write it off. Well, writing it off means this. Let's say you owed me $5,000 and you couldn't pay it. And I kept trying to collect it, and finally you moved to, Russia. Well, I'm never going to get that money that you owe me, am I? Well, then I have to eventually write that off my books. I can't show that as a $5,000 account receivable from Daniel. Well, for this bank, when they wrote it off, when you have a $2+ million loan, a receivable from a company who can't make their loan payments and then they declare bankruptcy, how do you think you're going to collect your $2 million plus? So eventually you have to write that off the books. You have to get it off the books. So you decrease that receivable and you hit an expense or a loss account and it kills your income statement. Not happy times. Not happy times. Think about how happy you'd be if a business owed you $2 million and they weren't going to pay, and how mad would you be if one of your commercial loan officers didn't do their proper homework and know how to analyze financial statements to know that that company was not healthy and they should not have had money loaned to them. See what I'm saying? Okay. All right, questions? Okay, I want to show you something real quick on the document camera. You don't have to turn to this, but in the back of your book is an example of a real-life company and their balance sheet. Okay, look at that top line. This is for Polaris Industries. This is their balance sheet. Current assets. The first line is it says cash and cash equivalents, and then it gives the amounts over there. Okay, well, what are these cash equivalents? I want to define that real quick. We know when we're talking about cash, we're talking about currency and savings accounts and all that sort of stuff. But we're also including in there in that line cash equivalents. What are cash equivalents? Cash equivalents are short-term, very highly liquid investments. An example would be like a 90-day certificate of deposit. They are very, very close to maturity, 90 days or less. They're readily convertible into cash. And you pretty much know what they're going to be cashed in for because they're so near maturity that their market value is not even affected by the interest rate changes. Okay? So this would not include those Chapter 15 investments in stock, investment in bonds, and those sort of things. Would not include those. These would be like a 90-day certificate of deposit or a 30-day CD or something like that. But those are what cash equivalents are. They're so close to cash that we put them on the same line as cash on the balance sheet. Okay? Now, the statement of cash flow has 3 sections. They have the operating section where they put their operating activities, the investing section where they put their investing activities, and the financing section where they put their financing activities. Let me show you an example of a cash flow statement. This is a fictitious company. But this section right here, you can see, is their operating section. It shows the cash flows from operating activities and the net cash provided by operating activities. This next section is your investing section. It's the cash flows from investing activities. And then it shows the net cash in regards to investing activities. And then this last section is the cash flows, or is the financing section. It shows the cash flows from financing activities and eventually the cash in regards to financing activities. Okay? Then what you do is you add these 3 numbers up, your net cash flows from operating, investing, and financing, and you get your net change in cash. Now, if that's a positive number, it's an increase in cash. If it's a negative number, it's a decrease in cash. And then you add that net change in cash to your beginning balance, and you get your ending balance. And of course, these numbers you would pull off of where? The balance sheet, correct? Now, taking a look at this number is a positive number, the 141. If this subtotal is a positive number, it's called net cash provided by whatever activity it is. Okay? Now these are negative numbers here, right? Negative 45,000 and negative 55,000. If that's a negative number, then we call that net cash used by. Net cash used by if it's a negative number in regards to whatever section you're in. Correct? Now here's the important deal. You need to be able to analyze a cash flow and know what section of the cash flow statement it belongs to. Okay? Come off that for a second. Think about when you learned how to prepare a balance sheet. Let's say you didn't know whether a certain account went in the asset section or the liability section or the equity section. You knew it went on the balance sheet, but you didn't know if it went in the asset, the liability, the equity section. You're not going to be able to prepare a balance sheet, are you? Or at least one that's meaningful and reliable for readers, right? You have to know what section of the balance sheet in that situation is, right? Well, going back to this cash flow statement, it's not enough to know that some sort of cash flow or activity goes on the cash flow statement. You need to know what section it goes in. Does it go in the operating section, the investing section, or the financing section? Are you with me? So our first order of business here, folks, is we need to learn, you can come off that, we need to be able to classify our cash flows. We need to be able to classify our cash flows. We need to be able to look at a cash flow and say, is this an operating activity, or is this an investing activity, or is this a financing activity? Now, my students have a tendency, they have a hard time with this. I don't know why, they just have a hard time with it. I'm going to give you some pointers and some tools that will help you learn it, but you need to learn this, okay? Let's talk about these different activities. Going to the screen. Let's skip over operating and let's actually move towards the investing cash flows. Investing cash flows. What are the 3 most common investing cash flows? Well, the 3 most common investing cash flows are buying or selling long-term investments. That's chapter 15, right? Buying or selling fixed assets, such as land, equipment, building, vehicles, things like that. Or loaning cash on or collecting principal on a long-term note receivable. Okay? Now, if you look at the accounting equation, which is asset equals liabilities plus owner's equity. Remember that? All of these items have to do with long-term items on the left side of the accounting equation, right? Long-term investments are long-term assets. Fixed assets are long-term assets. And of course, a long-term note receivable is a long-term asset. Does that make sense? So investing activities have to do over here on that side with long-term items on the left side of the accounting equation. But these are the three most common ones. Okay? Memorize those. Okay? Now let's talk about the three most common financing cash flows. Well, the three most common financing cash flows are issuing long-term debt, certainly including bonds, which we learned about in chapter 14, or paying principal on that long-term debt. Second most common financing cash flow is issuing stock, remember back in chapter 13, or buying back our own stock, treasury stock. Remember when we talked about treasury stock? And the third most common financing activity is paying dividends, which we also learned about in chapter 13. Now, kind of the rule of thumb here is if we go back to this accounting equation, assets equals liabilities plus owner's equity, the three most common financing activities have to do with long-term items on this side of the accounting equation, okay? With long-term items on the right side of the accounting equation. Are you with me? Okay. Now, take a look at these financing cash flows and take a look at the previous slide of the investing cash flows. I want you to recognize that these transactions occur in a business, but do you see how they're not going to occur like on a daily basis? Or they're not going to occur in the daily operations, every day. I mean, you might issue stock every now and then, but a lot of times it's just once, right? Initial public offering. Even if you pay dividends, you only do that quarterly at best, right? Or if you buy a big parcel of land, right? Or something like that. Do you see how these are activities that you would do, but they are not the daily operations of what you do? Well, you probably know where I'm going here, but operating activities, these are the cash flows that tend to be the recurring, repetitive transactions that occur in our business, in the operations of our business, such as receiving money from customers, paying salaries and wages, buying inventory, paying suppliers, paying the taxes that we owe. Okay? Do you see how those things would occur a lot more in the daily operations? You with me? Now notice a few of these that are in this category of operating cash flows. Notice that if you receive interest or if you pay interest, it is an operating activity. That was why on these slides I underlined principal right there and right there. Because if you pay or receive interest, it is an operating activity. Now, if you receive cash dividends, it is an operating activity. If you pay cash dividends, it's a financing activity. Okay? Now, I've given you some rules of thumb on learning these, okay? But you have to learn them. I will tell you, this happens, you can come off that. This happens every time I teach this subject, is I will have a quiz over this and I will have a test over this. And some people this section where I ask them to classify cash flows, what I do is I list out cash flows and you've got to tell me if they're an operating, investing, or financing. And people they do horrible on this. I've had people lower their test grade score by a grade and a half just because it was horrible. And I don't mean to be so picky on it, but again, you can't properly prepare a cash flow statement if you don't know how to classify your cash flows. Are you with me? So, one thing that I'm going to give you, Jeremiah, do me a favor, will you? Oh, you're right. Playing the role of Jeremiah will be Michael. can you hand one of those pages to each person? Just stand at the end of the aisle and pass it down. Okay. I'm giving you 2 pages. Let's take a look at the doc cam. Okay. I'm giving you 2 pages here, folks. And make sure that you have both pages because they kind of look similar. All right? This is the first page where I give you some operating activities. And then the next page, I give you some investing and some financing. Okay? Now, what I want you to do is cut these out, okay? And then on this line right here, just fold it, okay? So what you can do is you can make these little flashcards. Like here's an example. Buy or sell a fixed asset. Well, what type of activity is that? That is an investing activity, okay? So cut these out and make little flashcards, or just use these and copy it onto index cards. But that is a good way to learn your cash flows. Now here's what a lot of people do. They get lazy and so they go, well, I don't want to use scissors, okay? I don't want to go back to kindergarten and use scissors, so I'll just learn it off this sheet. Well, all these operatings are listed together, all the investing are listed together, and all the financing are listed together. So they get this false sense of security that they know what they're doing, and they don't. But if instead you get out your scissors and you cut these out and you make flashcards like this one and you mix them all up, that's how you learn, okay? That's how you learn these things. Now, I will tell you, how many people here are going to take managerial accounting? Okay, you're going to have to know this again for managerial accounting, okay? So whatever you do is going to be doubly blessed. We only have like 3 minutes left, but we're going to do something real quick. I want you in your book to do 16.2. Do this one right here and come back in a minute. Okay, let's go over these real quick. Number one, we're on Quick Study 16.2, right? Not 16.1, 16.2. Sold long and term investments for cash. What type of activity is that? Investing. Number two, received cash payments from customers? Operating. Paid cash for wages and salaries? Operating. 3 is operating. Purchased inventories for cash. Number 4? Operating. Number 5, paid cash dividends.
Financing.
Financing. Number 6, issued common stock for cash.
Financing.
Financing. Number 7, received cash interest on a note.
Operating.
Operating. Number 8, paid cash interest on a note.
Operating.
Operating. Receiving or paying interest is always operating. Number 9, received cash from the sale of land at a loss. Investing. And number 10, paid cash for property taxes on a building.
Operating.
Operating. Okay, so there are the answers to 1 through 10. Now you can keep that on there while I am talking. Next, I want you to learn these. I'm not giving you any homework, but you need to learn your cash flows classification. We are going to have a quiz next period that will be very, very similar to this quick study. Okay? Make your flashcards. You folks at home, I gave you those flashcards like this that you can in your handouts, okay? So get those out of your handouts. You can make those as well. So no homework, but learn your cash flow classifications. And I do not have a Chapter 14 Connect assignment, okay? Because I kind of teach it different than the book does. So no Chapter 14 Connect. See you guys. Next period is very important. Bring your calculators. Bye-bye.